Right now, we've got a high-quality problem. The average is making record high after huge rallies. Where is it safe to put new money to work in this market? Now, you can still find relatively inexpensive stocks if you know where to look. This weekend, we ran a screen searching for S&P 500 stocks with above-average growth and below-average price-to-earning multiples. At the moment, the S&P in the aggregate is expected to put up 12.5% earnings growth next year, and it sells for just under 22 times next year's numbers. You know, we want faster growth than that at a lower price. That's what you do a screen for. Turns out there's a surprising number of stocks that fit the bill, 104 of them to be exact. From there, I made some judgment calls. We booted the energy and materials names because I'm wary of those groups. That left us with 86 stocks. So we went through the list to find our favorites of those 86. Now, first, T-Mobile, which announced a leadership transition before the open this morning, with CEO Mike Sievert set to become vice chairman on November 1st, a bit of a surprise, and be succeeded by the company's current COO, Srini Gopalan. Now, Sievert's created a tremendous amount of value as he has been CEO, but I believe in this team. T-Mobile's on track to give you 19.4% earnings growth next year, yet it's selling for just over 18 times next year's numbers. Plain and simple. Next, from the consumer discretionary group, we've got two travel names. Royal Caribbean, my favorite of the cruise stocks, because it's the clear best of breed in one of my absolute favorite groups. And then there's Expedia, the online travel agency. Expedia is projected to put up 18% earnings growth next year, but it sells for 13 times next year's numbers. Oh, that is very cheap. In fact, it's much cheaper than key competitor Booking Holdings at 21 times earnings. So I say stick with Expedia. Booking's a very well-run company, though. After that, there's Dollar Tree. Now, that's the only member of the consumer staples that I like from this list. I think Dollar Tree can win in this environment as a destination for lower-income consumers who are searching for value. I like that they finally spun off that weaker Family Dollar business. And with the stock selling for less than 15 times next year's earnings with a 15% growth rate, again, that makes it a buy. Buy. Now, when we ran this screen, 34 of the 86 companies on the list came from the financials. Now, this is a great moment for the financial sector, as I've been trying to tell you pretty much nightly. So I'm going to run through my favorites in rapid-fire format. There were a couple of credit card plays, including Charitable Trust holding Capital One Financial, COF, which just merged with Discover and is projected to have nearly 14% earnings growth next year, despite selling for just roughly 11 times next year's numbers. That's why I think it's such a buy. Then there's American Express, which just released a refreshed Platinum card. You might have gotten it this weekend, that I'm sure will be a hit, especially with millennials and Gen Z. Amex should have 12.6% earnings growth next year, just barely better than the market. And don't be surprised if the actual earnings growth surprises to the upside. At the same time, it's selling for less than 20 times next year's numbers. That's a bit cheaper than the overall S&P. Lots and lots of banks made the final list, and I really like two of them, one big and one small. The big one is Citigroup. Boy, is that strong. It should grow at a 28% clip next year. It trades at just 10.5 times 2026 earnings estimates. Well, that's strange. Citi's made a remarkable recovery under CEO Jane Fraser. And even though the stock's had a huge run, it remains the cheapest of the big banks. That's why that disparity is going to close the upside. For my small bank, you know what? I like Key Corp. That's that Cleveland-based parent of Key Bank. We've had them on a bunch of times. Fine regional bank, underrated capital markets business to boot. Key Corp's expected to grow at a 22% clip next year, yet trades at just under 11 times next year's numbers. Beyond the banks and the credit card issuers, Charles Schwab made the cut, and I'm a big fan of this retail brokerage house. Same goes for Chubb. That's the property and casualty insurance play that I think is best in show. There are even a couple of private equity stocks that look interesting based on this screen, like Apollo, which is now a leader in both private equity and private credit. It's projected to have roughly 19% earnings growth in 2026, but it sells for just 15.5 times next year's numbers. It's always traded at a pretty big discount to the market, though. What else? Now, we know healthcare has been mostly a wasteland this year, which is why only 4 stocks in the group passed the screen. Among those 4, the one that stands out to me is Incyte, a biopharma company with 9 approved products, mostly in oncology and dermatology, plus a robust pipeline, which is why the stock's up almost 23% year to date. Still, Incyte's expected to have 19% earnings growth, and it trades at just under 12 times next year's numbers. That's, again, way too cheap. A number of industrials made it through the screen, so let me cut to the quick here. Caterpillar, the machinery kingpin, has done incredibly well. It's up nearly 77% from its April lows. But you know what? I think it's got more upside. Stock's on track to put up 18% earnings growth, sells for 22 times next year's numbers. Cummins CMI works too. Their company's core truck engine business has headwinds from the prolonged weakness in the freight market, but Cummins has underappreciated data center exposure, making backup power generators for these warehouses full of servers that cannot go down. Finally, there's Jacobs Solutions. That's the engineering construction firm. We just had them on last week. Jacobs is involved in all sorts of design and constructing data centers, as well as new pharmaceutical plants. They work for Lilly and some of the other advanced manufacturing facilities that are hopefully coming back to America. It should have 16% earnings growth next year, and the stock sells for 21.5 times 2026 estimates. Next, several quality tech names made the final cut. For example, Dell Technologies, which you know I've liked so much, they made it. And though the stock's had its ups and downs over the past couple of years, it's still a core player in the AI infrastructure. I also like Jabil. Boy, that's a great company. Contract manufacturer, all sorts of electronics. It's becoming an even more valuable partner for its customers this year amid all of this trade uncertainty. Now, there's only one single solitary real estate company that made our list, and that's BXP. It's a company formerly known as Boston Properties, with a portfolio of mostly high-quality office properties in 6 major cities on the East and West Coast. Now, BXP trimmed its dividend earlier this month, which I thought it was going to really kill it, but they did say they needed the cash to devote to growth projects, which is why I think the stock bounced right back. Even after that, it's still got a 3.7% yield. Finally, I've got a utility that made the final cut, and it's called Entergy. That's a New Orleans-based utility. We've profiled them many times with a service area spanning from Mississippi to Texas. Entergy has a number of things going for it, from Meta's construction of a massive $10 billion data center in Louisiana to the ongoing build-out of liquefied natural gas export facilities. It's growing a little faster than the average stock in the S&P with a slightly lower price-to-earnings multiple. So here's the bottom line. Sometimes it can feel like there's nothing left to buy. You often hear about that. People say it's all moved. When you do a little work, you can find a host of cheaper-than-average stocks with above-average growth. Any one of the stocks I just mentioned is certainly worth your time looking into. Sava in Arizona. Sava.
Hey, Jim, my friends and I work hard in the gym. We can't stop eating our slop bowls. Therefore, Jim, what is the catalyst that's going to get Chipotle to move up? Is it an easier environment for consumers, or is it something we need to hear on the next earnings call?
I think it's a combination, Sava, and it's two things. One is that we absolutely have to have lower commodity prices, because I think that a lot of their commodities, particularly beef, really, really hurting. And then the second that you need is you got to have a clear roadmap for growth. And right now, I don't see that. It has to happen, or else people are not going to buy the stock. Let's go to Stephanie in Colorado, please. Stephanie.
Hello, Jim. I'm a frequent watcher of your show. Thank you for taking my call.
Oh, of course. Thank you for calling.
Yes, I am calling about Chevron. I've owned it since December 21, and it's a nice little dividend. And so I was just wondering about the future. It's, since the merger and purchase of Hess this July, and wanted to know, is it a buy, more, hold, or sell?
It's just a hold. The reason I say that, even though I think that Mike Wirth's doing a great job as CEO, is that I'm not a believer in the energy stocks. I actually sold the only energy stock for my travel trust not that long ago because I just don't think that they have the kind of growth that I want out of owning a stock. We like growth stocks here. We have a predilection for it because that's how big money is made. But thank you for the call. Now, if you do a little work, you can find a host of cheaper than average names out there, ones that still offer solid growth too. Hey, much more mad money at, including my exclusive with Quantum Player IONQ. Then it's getting difficult to own industrials in this tape. I'm taking a look at why there are so many sellers and why some other sectors just aren't working like they should be. And then, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.